Welcome back to Morning Trade Live. We've got a busy slate of Fed speakers today and then some data this week around Fed at minutes 2. Joining us, Jim Bianco from Bianco Research, President. Jim, good morning, sir. Good to have you here.
Thanks for having me.
All right, so let's first talk about your view on bonds, because generally in our conversations over the last year, you've been pretty bearish, looking for higher rates, looking for the kind of 5%. We got there basically, and then now it seems like you're thinking maybe the move is over. Take me through it.
Yeah, not quite over, but what we did was we got to about 475 in the middle of April, so about a month ago on bonds, and we started the year, back on December 27th at 380. So we had almost a 1% rise, and I'm talking about the 10-year yield. And I've had a target of 5 to 5.5, and that's because it would be a new high on the chart over the 5% peak in October. And at 470, I said, okay, most of the move is over. I still think we're probably going to need one more type of move up towards that 5.5, probably closer to 5, to get a capitulation out of the bond market, because too many people are kind of on this idea of time to get long bonds. And I tend to be a guy that believes in markets climb a wall of worry when they rally. So I moved to neutral because I said most of the move is over. I didn't move long because I thought maybe there was one more push up, but I didn't want to be greedy and hold out, being bearish all the way to 5%. So it's a low conviction idea here, right? We got most of the move done. I still think there might be a little bit more of a move higher. And that's why I'm kind of sitting at neutral right now.
Okay. So, Jim, when you think about what moves the needle here, is it going to be the type of commentary we get from Fed speakers, or do you think that the vol potential from that has been kind of sucked out by the last couple times we heard from Powell?
No, I think it has been pretty much laid out by Powell. And as a matter of fact, it was laid out by Powell last week. In his speech last week, I thought was pretty bearish for equities and for pushing for higher rates. And then we got the miss in inflation, and the market took off despite what Powell said. I think as far as Fed speak goes, really after Powell, there's only one other Fed person that can move the needle on the market, and that's Governor Waller, and he speaks Friday. And so I think that that's probably the most important speech to watch for the week. Other than that, the most important thing to watch for the week is going to be, obviously, at the close on Wednesday, NVIDIA's earnings, because that is probably taking on the aura of like a major economic release and how much it will impact all markets.
Okay. All right. So take me through kind of the positioning, how you do this, Jim, from investing, from a trading standpoint, especially when you go to your fund and look at the approach in WTBN. Tell me about it in the ETF. What's going to be the kind of position if I'm an investor thinking about bonds? Where does it fit into that part of the portfolio?
So it's a total return fixed income fund, WTBN. We manage an index called the Bianco Research Total Return Index, and the fund tracks our index. So we do it very similar to like the S&P committee. It manages the index, and SPY tracks the index. We have it set up very similar to that. Now, as far as the index goes, we're seeking to provide better than index type of returns for anybody that wants to be a bond investor. As I mentioned, we're neutral on duration. We were short on duration for most of the year. We've moved to neutral on duration. As far as like the yield curve, we're kind of neutral there too. You're kind of hitting me when we're kind of like, I feel like we're at the top of the roller coaster where everything kind of stops right now. And we're kind of at a neutral position there as well too. We are getting longer in the mortgage space. We've been buying and trying to get a little bit longer on the mortgage space. And the other position that we have is we are long the dollar. We still think that the dollar move has got more to go in our index. So we've got a 10% weighting long the dollar, thinking that we would see some kind of move up. And even with all of the Japanese intervention to knock down the yen, it's still above 156 again today, and it still seems to be moving. So that's how we're pretty much positioned. And the idea there again is if you're an investor that's looking for an exposure in the fixed income market, we're offering an alternative through an active approach.
Okay. And you're edging out the ag right now on the year to date so far. Jim, what do you think we should make of the general missing of economic data? We were beating like everything for months, and then it just turned on a dime about 2 weeks ago. Is that sign of real meaningful slowdown, or is it more a sign of just expectations got a little elevated after a couple good quarters of data?
So it's a little bit of both, and you've got it exactly right. You know, when we look at like the expectations index, being Bloomberg or Citibank's expectations index, they've been falling hard. Part of that is because economists finally gave up on the soft landing scenario and upped their forecast. So they made the hurdles harder to jump over. But the data that's weakening, if you drill down into it, is really what's called the soft or the survey data. So people like, you know, consumer confidence would be in that list, and so would Institute for Supply Management, Purchasing Managers Report would be on that list because they're surveys. So it's people are getting somewhat worried about the state of the economy, as opposed to what's referred to as like the hard data, retail sales, payrolls, durable goods, and the like. That data has, you know, it's kind of been meandering sideways. Now, if I had to give you one comment about the soft data, the unfortunate reality is when you ask people survey data, what does it correlate with? It correlates with politics. It correlates with their political viewpoints. What, you know, Republicans have a different viewpoint than Democrats about their economy, and it really depends on who's sitting in the White House. And if we switch the White House, then they'll do a 180 both positions as well. And that's why the soft data, I think, is weakening. I think it has more to do with the state of our politics than it does with the state of what we think about the economy.
Mm-hmm. Jim, when we've got scheduled this week with minutes in there, a lot of Fed speakers, but pretty minimal on the data, do you think we should get a good idea kind of where the path of least resistance is? Technically, what do you watch when you think about the potential to float either to the bottom or the top of the range? Because as you mentioned, you don't want to press the bet bearish bonds, but as you mentioned, you think we could still kind of drift higher. What are you looking at technically on the chart? What do you think might tell us which way we're going? What are the key areas?
Yeah, so let's look at 447 and the 10-year note, the yield 447. And the reason I want to look at that is that's effectively where the bond market was right before the CPI number came out.
Yes.
And we had a big rally. So if we can, you know, kind of make our way back and completely round trip that CPI rally, then I think that would be technically a failure of the market to really break down towards, you know, I'm talking about yields, break down towards lower yields then at that point. Now, we're not that far away again. We've kind of snuck up to 441 or 442. And I would also think about that level too. People have asked me about what is the relationship between bonds and stocks. And last fall and last month, when we got over 450 on the 10-year yield, the stock market really struggled. Last fall, it had a 10% correction. And by the middle of April, it had a 6% correction when we got to 475. So it seems like that 450 level for the stock market really then puts a big wind in the stock market's face. We're under it now. Stocks are rallying. We get to 447, not far away from 450, and we see yields stay there or go higher. You could expect that wind to be turned into the face of the stock market again.
All right. May 6th through 14th, basically, that whole range of trading there is that 447. So I think pretty much spot on. That's kind of the line in the sand from the last month here. I wanted to bring up a chart that's kind of a little bit of a more broad macro conversation, but I want to hit it while you're here, Jim, because it looks at basically the fiscal spending and how it relates to recessions. And I think it's really interesting because a lot of people basically say that we're going to be able to keep going, and a lot of what we're seeing from the economy is because we're spending so much on the government level. But when you look at federal spending as a percentage of nominal GDP, overlay it with recessions, it kind of looks like sometimes it goes up into recession, sometimes it goes down into recession. Tell me what you make of this chart.
So, you know, first of all, you'll see that big mountain in 2020. That was the COVID response. That we shut down the economy and we literally mailed people stimulus checks. But beyond that, what you see is what's called the Keynesian response, right? Whenever we have a shaded area, which is a recession, you'll see an increase of government spending because the government spends to try and stimulate the economy out of recession, and then it backs off on that spending in the next recovery. Now, we're in the fourth year of a recovery because the recovery started in April of 2020. And at 22% nominal spending to GDP, that is, the government is 1/5 of our economy. It's higher than any recession, except obviously the COVID response. And it's near the very peaks of what the government was doing to try and get us out of the Great Recession in 2009. In other words, the government is spending like we're in the middle of a recession, that we are panicked, that everybody's losing their jobs, and we're in a bear market. That is the level of spending that this government is doing right now. That's one of the reasons why I think inflation is going to stay sticky and it isn't going to come down. And this is now becoming more and more, this idea of fiscal dominance is becoming more and more of a thought here. Monetary policy isn't going to affect inflation as much as the fiscal situation. If the government keeps spending like this, we're just going to continue to have inflation. If the government keeps spending like this, we're not going to have a recession. We're not even going to have a soft landing. It's going to have to take the government to slow down, but it really does drive towards the inflation narrative.
Okay. So the idea here is we're still spending like it's recession, even though it's not. We're basically racking up months of unemployment below 4% too. That was another good chart that you had in a recent tweet thread about just showing how long we've been, in a pretty steady place unemployment-wise. So I guess as long as we don't crack that barrier, we shouldn't be too worried that softening of data is recessionary.
Yeah, exactly. We've gone 27 months in a row now with the unemployment rate under 4%. You got to go back to 1970 to find a period that was longer. If the unemployment rate for May is under 4% again, then you got to go back to the 1950s to find a period that was longer than that. Now, that's what the Fed and everybody's focused on is what if the labor market cracks? Would the Fed respond by cutting rates? And the answer is yes. But is there really any indications that the labor market is cracking? No, not really. I mean, the initial claims number popped up a few thousand jobs and then it came right back down. Some of the other measures, whether it's in the ISM surveys or the National Federation of Independent Business surveys, are saying that the labor market seems to be okay. So I agree with the assessment that if we saw signs of weakness in the labor market, you might see an immediate response out of this Federal Reserve to cut rates. But we're not seeing signs of weakness. Yeah, the payroll report missed at 176,000 jobs, but it's 176,000 jobs. That's more than economists would tell us we need for population growth and for economic growth. So the labor market seems to be doing okay for right now.
All right, great stuff, Jim. Good to catch up. Always like the economic charts and fresh look at bonds. A little more neutral, a little less conviction on the bearish side. Thank you, Jim. Appreciate it.
Thank you.
Have a good one, Mr. Bianco, President and Bianco Research.